HAPTER 8. Multiple Candlestick Patterns Part 1. 8.1 The Engulfing Pattern. In a single candlestick pattern, the trader needed just one candlestick to identify a trading opportunity. However, when analyzing multiple candlestick patterns, the trader needs 2 or sometimes 3 candlesticks to identify a trading opportunity. This means the trading opportunity evolves over a minimum of 2 trading sessions. The engulfing pattern is the first multiple candlestick pattern that we need to look into. The engulfing pattern needs 2 trading sessions to evolve. In a typical engulfing pattern, you will find a small candle on day 1 and a relatively long candle on day 2, which appears as if it engulfs the candle on day 1. If the engulfing pattern appears at the bottom of the trend, it is called the bullish engulfing pattern. If the engulfing pattern appears at the top end of the trend, it is called the bearish engulfing pattern. 8.2 The bullish engulfing pattern. The bullish engulfing pattern is a 2-candlestick pattern which appears at the bottom of the downtrend. As the name suggests, this is a bullish pattern which prompts the trader to go long. The 2-day bullish engulfing pattern is encircled in the chart below. The prerequisites for the pattern are as follows. The prior trend should be a downtrend. The first day of the pattern, P1, should be a red candle reconfirming the bearishness in the market. The candle on the second day of pattern, P2, should be a blue candle, long enough to engulf the red candle. The thought process behind the bullish engulfing pattern is as follows. The market is in downtrend with prices steadily moving down. On the first day of the pattern, P1, the market opens low and makes a new low. This forms a red candle in the process. On the second day of the pattern, P2, the stock opens near the closing prices of P1 and attempts to make a new low. However, at this low point of the day there is a sudden buying interest, which drives the prices to close higher than the previous day's open. This price action forms a blue candle. The price action on P2 also suggests that bulls made a very sudden and strong attempt to break the bearish trend, and they did so quite successfully. This is evident by the long blue candle on P2. The bears would not have expected the bulls' sudden action on P2, and hence the bulls' action kind of rattles the bears, causing them some amount of nervousness. The bullishness is expected to continue over the next few successive trading sessions, driving the prices higher, and hence the trader should look for buying opportunities. The trade setup for the bullish engulfing pattern is as follows. The bullish engulfing pattern evolves over 2 days. The suggested buy price is around the close price of blue candle IE on P2. Risk taker initiates the trade on P2 itself after ensuring P2 is engulfing P1. The risk averse initiates the trade on the next day, i.e. the day after P2, around the closing price, after confirming the day is forming a blue candle. If the day after P2 is a red candle day, the risk averse trader will ignore the trade, owing to Rule 1 of candlesticks, buy strength and sell weakness. On a personal note, in multiple candlestick patterns where the trade evolves over 2 or more days, it is worth to be a risk taker as opposed to a risk-averse trader. The stop loss for the trade would be at the lowest low between P1 and P2. Needless to say, once the trade has been initiated, you will have to wait until the target has been hit or the stop loss has been breached. Of course, one can always trail the stop loss to lock in profits. Have a look at DLF's chart below. The bullish engulfing pattern is encircled. The OHLC on P1 open equals 163. High equals 168. Low equals 158.5. Close equals 160. On P2 the OHLC details are open equals 159.5. High equals 170.2. Low equals 159. Close equals 169. The trade setup for the bullish engulfing pattern is as follows. The risk taker would go long on P2 at 169. He can do this by validating P2 as an engulfing pattern. To validate P2 as an engulfing pattern, there are 2 conditions. 1. The current market price at 3:20 p.m. on P2 should be higher than P1's open. 2nd. The open on P2 should be equal to or lower than P1's close. The risk-averse will initiate the trade the day after P2 only after ensuring that the day is a blue candle day. So if the P1 falls on a Monday, the risk-averse would be initiating the trade on Wednesday, around 3:20 p.m. However, as I had mentioned earlier, while trading based on multiple candlestick pattern, it may be worth initiating the trade on pattern completion day itself, i.e. P2. The stop loss on this trade will be the lowest low between P1 and P2. In this example, lowest low falls on P1 at 158.5. In this example, both the risk-averse and the risk-taker would have been profitable. Here is an example of a perfect bullish engulfing pattern formed on Cipla Limited. The risk-averse trader would have completely missed out a great trading opportunity. There is often a lot of confusion on whether the candle should engulf just the real body or the whole candle, including the lower and upper shadows. In my personal experience, as long as the real bodies are engulfed, I would be happy to classify the candle as a bullish engulfing pattern. Of course, candlestick sticklers would object to this, but what really matters is how well you hone your skills in trading with a particular candlestick pattern. So going by that thought, I'd be happy to classify the following pattern as a bullish engulfing pattern, even though the shadows are not engulfed. 8.3 The bearish engulfing pattern. The bearish engulfing pattern is a two-candlestick pattern which appears at the top end of the trend, thus making it a bearish pattern. The thought process remains very similar to the bullish engulfing pattern, except one has to think about it from a shorting perspective. Take a look at the chart below. The two candles that make up the bearish engulfing pattern is encircled. You will notice, to begin with, the bulls are in absolute control, pushing the prices higher. On P1, as expected, the market moves up and makes a new high, reconfirming a bullish trend in the market. On P2, as expected, the market opens higher and attempts to make a new high. However, at this high point, selling pressure starts. This selling comes unexpected and hence tends to displace the bulls. The sellers push the prices lower, so much so that the stock closes below the previous day's P1 open. This creates nervousness amongst the bulls. The strong sell on P2 indicates that the bears may have successfully broken down the bulls' stronghold in the market, may continue to witness selling pressure over the next few days. The idea is to short the index or the stock in order to capitalize on the expected downward slide in prices. The trade setup would be as follows. The bearish engulfing pattern suggests a short trade. The risk-taker initiates the trade on the same day after validating two conditions. The open on P2 is higher than P1 as close. The current market price at 3:20 p.m. on P2 is lower than P1's open price. If the two conditions are satisfied, then it would be logical to conclude that it is a bearish engulfing pattern. The risk-averse will initiate the trade on the day after P2 only after ensuring that the day is a red candle day. Since the bearish engulfing pattern is a two-day pattern, it makes sense to be a risk-taker. However, this purely depends on the individual's risk appetite. Take a look at the chart below of Ambuja Cements. There are two bearish engulfing patterns formed. The first pattern on the chart, encircled, starting from left, did not work in favor of a risk-taker. However, the risk-averse would have completely avoided taking the trade. The second bearish engulfing pattern would have been profitable for both the risk-taker and the risk-averse. The OHLC data for the bearing engulfing pattern, encircled at the top end of the chart, is as below. P1. Open 214. High 220. Low 213.3. Close 218.75. P2. Open 220. High 221. Low 207.3. Close 209.4. The trade setup for the short trade, based on the bearish engulfing pattern, is as follows. On P2 by 3:20 p.m. the risk-taker would initiate the short trade at 209 after ensuring P1 and P2 together form a bearish engulfing pattern. The risk-averse will initiate the trade the day after P2 only after ensuring that the day is a red candle day. The stop loss in both the cases will the highest high of P1 and P2, which in this case is at 221. Both the risk-averse and the risk-taker would have been profitable in this particular case. 8.4 The presence of a doji. Now here is a very interesting chart. From my own personal experience, I can tell you Charts like the one shown below are highly profitable. One should not miss such trading opportunities. Take a look at the chart. What are the things that catch your attention? An obvious uptrend is highlighted. A bearish engulfing pattern right at the top end of the upward rally. A doji formation on the day following P2. What implication would a doji have in this chart? Let us inspect this chart event by event. A prolonged uptrend in the chart confirms the bulls are in absolute control. On P1 a blue candle is formed, reconfirming the bulls' dominance in the markets. On P2 markets open higher and make a new high, comforting the bulls. However, at the high point a strong surge to sell builds up, to an extent that the prices closes below P1's opening prices. This trading action on P2 sets in a bit of panic to bulls, but they are not shaken yet. On day 3, let us call it as P3. Though the opening is weak, it is not much lower compared to P2's close. This is not too comforting for the bulls, as they expect the markets to be stronger. During P3 the market attempts to move higher, doji's upper shadow, however the high is not sustained. Even the low is not sustained and eventually the day closes flat, forming a doji. As you may recall, dojis indicate indecision in the market. On P2 bulls panicked and on P3 bulls were uncertain. Panic with uncertainty is the perfect recipe for a catastrophe, which explains the long red candle following the doji. From my own personal trading experience I can tell you that whenever a doji follows a recognizable candlestick pattern, the opportunity created is bigger. Besides illustrating this point, I also want to draw your attention to chart analysis methodology. Notice in this particular chart, we did not just look at what was happening on P1 or P2, but we went beyond that and actually combined two different patterns to develop a comprehensive view on the market. 8.5 The piercing pattern. The piercing pattern is very similar to the bullish engulfing pattern with a very minor variation. In a bullish engulfing pattern, the P2's blue candle engulfs P1's red candle completely. However, in a piercing pattern, P2's blue candle partially engulfs P1's red candle. However, the engulfing should be between 50% and less than 100%. You can validate this visually or calculate the same. For example, if P1's range open, close is 12. P2's range should be at least 6 or higher but below 12. As long as this condition is satisfied, everything else is similar to the bullish engulfing, including the trade setup. Here a risk taker would initiate the trade on P2 around the close. The risk averse would initiate the trade the day after P2 only after ensuring a blue candle is formed. The stop loss would be the low of the pattern. Have a look at the following chart. Here P2's blue candle engulfs just under 50% of P1's red candle. For this reason we do not consider this as a piercing pattern. 8.6 The dark cloud cover. The dark cloud cover is very similar to the bearish engulfing pattern with a minor variation. In a bearish engulfing pattern, the red candle on P2 engulfs P1's blue candle completely. However, in a dark cloud cover, the red candle on P2 engulfs about 50 to 100% of P1's blue candle. The trade setup is exactly the same as the bearish engulfing pattern. Think about the dark cloud cover as the inverse of a piercing pattern. 8.7 A perspective on selecting a trade. Typically stocks in the same sector have similar price movement. For example, think about TCS and Infosys or a CC Bank and HDFC Bank. Their price movement is similar because these companies are more or less of the same size, have similar business, and the same external factors that affect their business. However, this does not mean their stock price movement would match point to point. For example, if there is negative news in the banking sector, banking stocks are bound to fall. In such a scenario, if the stock price of a CC Bank falls by 2%, it is not really necessary that HDFC Bank's stock price should also fall exactly 2%. Probably HDFC Bank stock price may fall by 1.5% or 2.5%. Hence the two stocks may form two different but somewhat similar candlestick patterns such as a bearish engulfing and dark cloud cover at the same time. Both these are recognizable candlestick patterns, but if I were to choose between the two patterns to set up a trade, I would put my money on the bearish engulfing pattern as opposed to a dark cloud cover. This is because the bearishness in a bearish engulfing pattern is more pronounced due to the fact that it engulfs the previous day's entire candle. On the same lines, I would choose a bullish engulfing pattern over a piercing pattern. However, there is an exception to this selection criterion. Later in this module, I will introduce a 6-point trading checklist. A trade should satisfy at least 3 to 4 points on this checklist for it to be considered as a qualified trade. Keeping this point in perspective, assume there is a situation where the SCC Bank stock forms a piercing pattern and the HDFC Bank stock forms a bullish engulfing pattern. Naturally, one would be tempted to trade the bullish engulfing pattern. However, if the HDFC Bank stock satisfies 3 checklist points, and a SCC Bank stock satisfies 4 checklist points, I would go ahead with the SCC Bank stock even though it forms a less convincing candlestick pattern. On the other hand, if both the stocks satisfy 4 checklist points, I will go ahead with the HDFC Bank trade. Key takeaways from this chapter. Multiple candlestick patterns evolve over 2 or more trading days. The bullish engulfing pattern evolves over 2 trading days. It appears at the bottom end of downtrend. Day 1 is called P1 and day 2 is called P2. In a bullish engulfing pattern, P1 is a red candle, and P2 is a blue candle. P2's blue candle completely engulfs P1's red candle. A risk taker initiates a long trade at the close of P2 after ensuring P1 and P2 together form a bullish engulfing pattern. A risk-averse trader will initiate the trade the day after P2. Near the close of the day, the stop loss for the bullish engulfing pattern is the lowest low between P1 and P2. The bearish engulfing pattern appears at the top end of an uptrend. P1's blue candle is completely engulfed by P2's red candle. A risk taker initiates a short trade at the close of P2 after ensuring P1 and P2 together form a bearish engulfing pattern. The risk-averse trader will initiate the trade the day after P2. After confirming the day forms a red candle, the highest high of P1 and P2 forms the stop loss for a bearish engulfing pattern. The presence of a doji after an engulfing pattern tends to catalyze the pattern's evolution. The piercing pattern works very similar to bullish engulfing pattern, except that P2's blue candle engulfs at least 50% and below 100% of P1's red candle. The dark cloud cover works similar to the bearish engulfing pattern, except that P2's red candle engulfs at least 50% and below 100% of P1's blue candle. Chapter 9. Multiple Candlestick Patterns, Part 2. 9.1 The Harami Pattern. Before you get thinking, the word harami does not stand for the word harami used in Hindi slightly smiling face. Apparently it is old Japanese word for pregnant. You'd appreciate the intuitiveness of this word when you see the candlestick formation. Harami is a 2-candle pattern. The first candle is usually long and the second candle has a small body. The second candle is generally opposite in color to the first candle. On the appearance of the harami pattern, a trend reversal is possible. There are 2 types of harami patterns, the bullish harami and the bearish harami. 9.2 The bullish harami. As the name suggests, the bullish harami is a bullish pattern appearing at the bottom end of the chart. The bullish harami pattern evolves over a 2-day period, similar to the engulfing pattern. In the chart below, the bullish harami pattern is encircled. The thought process behind a bullish harami pattern is as follows. The market is in a downtrend pushing the prices lower, therefore giving the bears absolute control over the markets. On day 1 of the pattern, P1, a red candle with a new low is formed, reinforcing the bears' position in the market. On day 2 of the pattern, P2, the market opens at a price higher than the previous day's close. On seeing a high opening price, the bears panic, as they would have otherwise expected a lower Opening price. The market gains strength on P2 and manages to close on a positive note, thus forming a blue candle. However, P2's closing price is just below the previous day's P1 open price. The price action on P2 creates a small blue candle which appears contained pregnant within P1's long red candle. The small blue candle on a standalone basis looks harmless. But what really causes the panic is the fact that the bullish candle appears all of a sudden, when it is least expected. The blue candle not only encourages the bulls to build long positions, but also unnerves the bears. The expectation is that panic amongst the bears will spread in an accelerated manner, giving a greater push to bulls. This tends to push the prices higher. Hence one should look at going long on the stock. The trade setup for the bullish harami is as follows. The idea is to go long on the bullish harami formation. Risk takers can initiate a long trade around the close of the P2 candle. Risk takers can validate the following conditions to confirm if P1 and P2 together form a bullish harami pattern. The opening on P2 should be higher than the close of P1. The current market price at 3:20 p.m. on P2 should be less than P1's opening price. If both these conditions are satisfied, then one can conclude that both P1 and P2 together form a bullish harami pattern. The risk-averse can initiate a long trade at the close of the day after P2, only after confirming that the day is forming a blue candle. The lowest low of the pattern will be the stop loss for the trade. Here is a chart of Axis Bank. The bullish harami is encircled below. The OHLC details for the pattern are as follows. P1 open equals 868. High equals 874. Low equals 810. Close equals 815. P2 open equals 824. High equals 847. Low equals 818. Close equals 835. The risk taker would initiate the long position at the close of P2, which is around 835. The stop loss for the trade would be lowest low price between P1 and P2, which in this case, it is 810. The risk-averse will initiate the trade the day near the close of the day after P2, provided it is a blue candle day, which in this case is. Once the trade has been initiated, the trader will have to wait for either the target to be hit or the stop loss to be triggered. Here is a chart below where the encircled candles depict a bullish harami pattern. But it is not. The prior trend should be bearish. But in this case the prior trend is almost flat, which prevents us from classifying this candlestick pattern as a bullish harami. And here is another example where a bullish harami occurred but the stop loss on the trade triggered, leading to a loss. 9.3 The bearish harami. The bearish harami pattern appears at the top end of an uptrend, which gives the trader a opportunity to initiate a short trade. The thought process behind shorting a bearish harami is as follows. The market is in an uptrend, placing the bulls in absolute control. On P1, the market trades higher and makes a new high and closes positively, forming a blue candle day. The trading action reconfirms the bulls' dominance in the market. On P2, the market unexpectedly opens lower, which displaces the bulls and sets in a bit of panic to bulls. The market continues to trade lower to an extent where it manages to close negatively, forming a red candle day. The unexpected negative drift in the market causes panic, making the bulls to unwind their positions. The expectation is that this negative drift is likely to continue, and therefore one should look at setting up a short trade. The trade setup for the short trade based on bearish harami is as follows. The risk taker will short the market near the close of P2 after ensuring P1 and P2 together forms a bearish harami. To validate this, two conditions must be satisfied. The open price on P2 should be lower than the close price of P1. The close price on P2 should be greater than the open price of P1. The risk-averse will short the market the day after P2 after ensuring it forms a red candle day. The highest high between P1 and P2 acts as the stop loss for the trade. Here is a chart of IDFC Limited where the bearish engulfing pattern is identified. The OHLC details are as follows. P1 open equals 124. High equals 129. Low equals 122. Close equals 127. P2 open equals 126.9. High equals 129.70. Low equals 125. Close equals 124.80. The risk taker will initiate the trade on day 2, near the closing price of 125. The risk averse will initiate the trade on the day after P2, only after ensuring it forms a red candle day. In the above example, the risk averse would have avoided the trade completely. The stop loss for the trade would be the highest high between P1 and P2. In this case it would be 129.70. Key takeaways from this chapter. The Harami pattern evolves over 2 trading sessions, P1 and P2. Day 1, P1, if the pattern forms a long candle, and Day 2, P2, if the pattern forms a small candle, which appears as if it has been tucked inside the P1 as long candle. A bullish Harami candle pattern is formed at the lower end of a downtrend. P1 is a long red candle, and P2 is a small blue candle. The idea is to initiate a long trade near the close of P2, risk taker. A risk-averse trader will initiate the long trade near the close of the day after P2 only after ensuring it forms a blue candle day. The stop loss on a bullish Harami pattern is the lowest low price between P1 and P2. The bearish Harami pattern is formed at the top end of an uptrend. P1 is a long blue candle, and P2 is a small red candle. The idea is to initiate a short trade near the close of P2, risk taker. The risk-averse will initiate the short near the close of the day only after ensuring it is a red candle day. The stop loss on a bearish Harami pattern is the highest high price between P1 and P2. Chapter 10. Multiple Candlestick Patterns, Part 3. The morning star and the evening star are the last 2 candlestick patterns we will be studying. Before we understand the morning star pattern, we need to understand 2 common price behaviors: gap up opening and gap down opening. Gaps, a general term used to indicate both gap up and gap down, are a common price behavior. A gap on a daily chart happens when the stock closes at one price but opens on the following day at a different price. 10.1 The gaps. Gap up opening. A gap up opening indicates buyers' enthusiasm. Buyers are willing to buy stocks at a price higher than the previous day's close. Hence, because of enthusiastic buyers' outlook, the stock or the index opens directly above the previous day's close. For example, consider the closing price of ABC Limited was 100 rupees on Monday. After the market closes on Monday, assume ABC Limited announces their quarterly results. The numbers are so good that on Tuesday morning the buyers are willing to buy the stock at any price. This enthusiasm would lead to stock price jumping to 104 rupees directly. This means though there was no trading activity between 100 rupees and 104 rupees, yet the stock jumped to 104 rupees. This is called a gap up opening. Gap up opening portrays bullish sentiment. In the following image, the green arrows points to a gap up openings. Gap down opening, similar to gap up opening. A gap down opening shows the enthusiasm of the bears. The bears are so eager to sell that they are willing to sell at a price lower than the previous day's close. In the example stated above, if the quarterly results were bad, the sellers would want to get rid of the stock and hence the market on Tuesday could open directly at 95 rupees instead of 100 rupees. In this case, though there was no trading activity between 100 rupees and 95 rupees, yet the stock plummeted to 95 rupees. Gap down opening portrays bearish sentiment. In the following image, the green arrows points to a gap down opening. 10.2 The morning star. The morning star is a bullish candlestick pattern which evolves over a 3-day period. It is a downtrend reversal pattern. The pattern is formed by combining 3 consecutive candlesticks. The morning star appears at the bottom end of a downtrend. In the chart below, the morning star is encircled. The morning star pattern involves 3 candlesticks sequenced in a particular order. The pattern is encircled in the chart above. The thought process behind the morning star is as follows. Market is in a downtrend, placing the bears in absolute control. Market makes successive new lows during this period. On day 1 of the pattern, P1. As expected, the market makes a new low and forms a long red candle. The large red candle shows selling acceleration. On day 2 of the pattern, P2, the bears show dominance with a gap down opening. This reaffirms the position of the bears. After the gap down opening, nothing much happens during the day, P2, resulting in either a doji or a spinning top. Note the presence of doji, spinning top represents indecision in the market. The occurrence of a doji, spinning sets in a bit of restlessness within the bears, as they would have otherwise expected another down day, especially in the backdrop of a promising gap down opening. On the third day of the pattern, P3, the market stock opens with a gap up followed by a blue candle, which manages to close above P1's red candle opening. In the absence of P2's doji, spinning top, it would have appeared as though P1 and P3 formed a bullish engulfing pattern. P3 is where all the action unfolds. On the gap up opening itself, the bears would have been a bit jittery. Encouraged by the gap up opening, buying persists through the day, so much so that it manages to recover all the losses of P1. The expectation is that the bullishness on P3 is likely to continue over the next few trading sessions, and hence one should look at buying opportunities in the market. Unlike the single and two candlestick patterns, both the risk-taker and the risk-averse trader can initiate the trade on P3 itself. Waiting for a confirmation on the fourth day may not be necessary while trading based on a morning star pattern. The long trade setup for a morning star would be as follows. Initiate a long trade at the close of P3 around 3:20 p.m. after ensuring that P1, P2, and P3 together form a morning star. To validate the formation of a morning star on P3, the following conditions should satisfy. P1 should be a red candle with a gap down opening. P2 should be either a doji or a spinning top. P3 opening should be a gap up. Plus, the current market price at 3:20 p.m. should be higher than the opening of P1. The lowest low in the pattern would act as a stop loss for the trade. 10.3 The Evening Star. The evening star is the last candlestick pattern that we would learn in this module. The evening star is a bearish equivalent of the morning star. The evening star appears at the top end of an uptrend. Like the morning star, the evening star is a three-candle formation and evolves over 3 trading sessions. The reasons to go short on an evening star are as follows. The market is in an uptrend, placing the bulls in absolute control. During an uptrend, the market stock makes new highs. On the first day of the pattern, P1. As expected, the market opens high, makes a new high and closes near the high point of the day. The long blue candle formed on day 1, P1, shows buying acceleration. On the second day of the pattern, P2, the market opens with a gap reconfirming the bull's stance in the market. However, after the encouraging open, the market stock does not move and closes by forming a doji, spinning top. The closing on P2 sets in a bit of panic for bulls. On the third day of the pattern, P3, the market opens gap down and progresses into a red candle. The long red candle indicates that the sellers are taking control. The price action on P3 sets the bulls in panic. The expectation is that the bulls will continue to panic and hence the bearishness will continue over the next few trading sessions. Therefore, one should look at shorting opportunities. The trade setup for an evening star is as follows. Short the stock on P3 around the close of 3:20 p.m. after validating that P1 to P3 form an evening star. To validate the evening star formation on day 3, one has to evaluate the following. P1 should be a blue candle. P2 should be a doji or a spinning top with a gap up opening. P3 should be a red candle with a gap down opening. The current market price at 3:20 p.m. on P3 should be lower than the opening price of P1. Both risk-taker and risk-averse can initiate the trade on P3. The stop loss for the trade will be the highest high of P1, P2, and P3. 10.4 Summarizing the entry and exit for candlestick patterns. Before we conclude this chapter, let us summarize the entry and stop loss for both long and short trades. Remember, during the study of candlesticks, we have not dealt with the trade exit, aka targets. We will do so in the next chapter. Risk-taker. The risk-taker enters the trade on the last day of the pattern formation around the closing price, 3:20 p.m. The trader should validate the pattern rules, and if the rules are validated, then the opportunity qualifies as a trade. Risk-averse. The risk-averse trader will initiate the trade after he identifies a confirmation on the following day. For a long trade, the color of candle should be blue, and for a short trade, the color of the candle should be red. As a rule of thumb, higher the number of days involved in a pattern, the better it is to initiate the trade on the same day. The stop loss for a long trade is the lowest low of the pattern. The stop loss for a short trade is the highest high of the pattern. 10.5 What next? We have looked at 16 candlestick patterns. And is that all, you may wonder? No, not really. There are many candlestick patterns, and I could go on explaining these patterns, but that would defeat the ultimate goal. The ultimate goal is to understand and recognize the fact that candlesticks are a way of thinking about the markets. You need not know all the patterns. Think about car driving. Once you learn how to drive a car, it does not matter which car you drive. Driving a Honda is pretty much the same as driving a Hyundai or Ford. Driving comes naturally irrespective of which car you are driving. Likewise, once you train your mind to read the thought process behind a candlestick, it does not matter which pattern you see. You will exactly know how to react and how to set up a trade based on the chart that you are seeing. Of course, in order to reach this stage, you will have to go through the rigor of learning and trading the standard patterns. So my advice to you would be to know the patterns that we have discussed here. They are some of the most frequent and profitable patterns to trade on the Indian markets. As you progress, start developing trades based on the thought process behind the actions of the bulls and the bears. This, over time, is probably the best approach to study candlesticks. Key takeaways from this chapter. Star formation occurs over 3 trading sessions. The candle of P2 is usually a doji or a spinning top. If there is a doji on P2 in a star pattern, it is called the doji star, morning doji star, evening doji star, else it is just called the star pattern, morning star, evening star. Morning star is a bullish pattern which occurs at the bottom end of the trend. The idea is to go long on P3 with the lowest low of the pattern being the stop loss for the trade. Evening star is a bearish pattern, which occurs at the top end of an uptrend. The idea is to go short on P3, with the highest high of the pattern acting as a stop loss. The star formation evolves over a 3 days period. Hence both the risk-averse and risk-taker are advised to initiate the trade on P3. Candlesticks portray the trader's thought process. One should nurture this thought process as he dwells deeper into the candlestick study.